Good morning. And thank you, Ronaldo, for that introduction. And I guess I should also thank Peter Sachs, because it was about a year ago that Peter and I were having a drink at a bar in New York City. And Peter said, "Why don't I ever see you at Center Cafe?" And I said, "Because you've never invited me to Center Cafe." And on the spot, he invited me to Center Cafe, and now here I am. And I'm happy to be here. I'm equally happy that Brown Brothers Harriman is a sponsor of Center Cafe, because coffee has always been very important to us. Brown Brothers Harriman, as a bank and as an investment advisor, was founded in 1818. And because we throw away nothing, we still have the loan book, and back then it was a real, live, honest-to-God book, pages bound together, from 1818. It's on display in our offices, and if you're ever in New York, I would be delighted to show it to you. The very first loan that the bank ever made in March of 1818 was to finance a coffee trade. And we've been in that business now for 207 years, so it feels very much like home to be with people like you who are in the coffee business. Several months ago, when Noelia was prodding me for my presentation, and she said, "Well, I at least need a title." And I think I said to Noelia something like, "Well, what should I talk about?" And she said, "Well, there's just so much going on. Can you just make it make sense?" And I thought, that's a perfect title. So I have Noelia to thank for the title. What I'm going to do over the next now 28 minutes and 36 seconds is try to make it make a little bit of sense. It's hard because things move so rapidly and so quickly. When I got on the plane yesterday to leave New York, the government was still closed. When I went to bed last night here, it was open again. So maybe I should have just left the country earlier, and this all would have happened a lot more quickly. But as you know, there was a deal signed last night to reopen the government. On those occasions, when the federal government in the United States closes, we learn what aspects of the government are deemed to be essential and what aspects are deemed to be non-essential. Essential workers like air traffic control, TSA, are expected to arrive at work although they're not getting paid. Non-essential workers are just furloughed. They don't show up to work. They'll come back eventually. It turns out, astonishingly, economic data falls into the non-essential category. So we have learned nothing from at least public sources over the past 45 days about what's going on with inflation, economic activity, consumer spending, the housing market, international trade, a whole host of things. There are private sector sources, and we're going to look at some of those briefly, that help to fill in some of those gaps. Now that the government is reopened, I think we will backfill some of that data, but probably not all of it, because some of the data simply wasn't collected. So there will continue to be a sort of gap in the middle of it. I do think, last bullet point on this page, we will fill in enough of those gaps that when the U.S. Central Bank, the Federal Reserve, next meets on December 10th, they will have enough insight and enough economic information to justify lowering interest rates again by 25 basis points, which would be a continuation of what they've been doing. But just to run through some of this, my usual sources of data: the U.S. Bureau of Labor Statistics, closed for business, thanks for asking. The U.S. Census Bureau, which interestingly provides a lot of information on international trade, closed for business, thanks for asking. The Bureau of Economic Analysis, the gross domestic product, personal income, closed for business. Even the Transportation Security Administration, although the TSA officers are showing up for work, the statisticians and data people didn't. Closed for business, thanks for asking. Let's look at some alternative private sector data that helps to fill in some of these gaps. What I really focus on as an economist is the health of household spending. In the United States of America, household spending, personal consumption, accounts for 68% of GDP. 68 cents of every dollar of the American economy is a spending decision made by an individual. Sounds a little counterintuitive, because what you read about all the time is tariffs and trade and business spending and government spending. Those things are important, but altogether they add up to about 32% of GDP. 68% is personal spending. So I'm really interested in the labor market. Whether or not people have a job and whether or not they have confidence in their jobs helps to drive spending. I'm really interested in the housing market. For the vast majority of Americans, the single most valuable asset they own is the equity in their home. So the health of the housing market is also a big driver of not only the ability of people to spend money, but maybe more importantly, the willingness to spend money. I'm going to jump to the conclusion and just say I think there's clear evidence of a slowdown in U.S. economic activity, even aside from the closure of the government for 45 days. Even prior to that, there's a fair amount of evidence of a slowdown. You see a little bit of it here. What I'm showing you here is both the official Bureau of Labor Statistics data in red and then ADP, the big payroll processor. Both report monthly net job gains. As you can see, they're different. There's a 78% correlation. It's pretty high. They're not identical, though. If you look at what I've circled there in the lower right-hand corner, the red bars are missing. We haven't had the official BLS data for a couple of months. But if you look at the ADP data, it seems clear to me that there's a slowdown in the labor market taking place. We are just adding fewer jobs. It's not catastrophic. We haven't sailed off of a cliff. There aren't a whole lot of evidence of people mass layoffs quite yet, but there's clearly something going on. What's going on, interestingly, has nothing to do with the policies of this administration, the Trump administration. It is instead just a good old-fashioned dynamic of supply and demand. Economic concept very familiar in this room. That law of supply and demand appeals to any market, including the market for labor. What you're looking at here is a simple supply and demand graph for labor, for employees. The red line on this page is the available supply of labor. We normally think about that as the unemployment rate, people who do not have jobs but are looking for jobs. You can see the pandemic, right? It's quite obvious what that is. The blue line is job openings, so think of that as demand for labor. And if you look back 3 or 4 years ago on this graph, there were as much as 5 or 6 million more job openings, that's the blue line, than there were people available to fill them. So coming out of the pandemic, a huge imbalance in supply and demand. To catch that up, to narrow that imbalance, the U.S. economy was adding hundreds of thousands of jobs a month. But look at where we are now. That supply and demand is back into balance. Again, this is not catastrophic. If you look at the rest of this chart, which goes back to 2001, that's not an abnormal state of affairs. It simply says that as that supply and demand is back into balance, we're not likely in the United States to continue adding hundreds of thousands of jobs a month. It's just a much more balanced market. That's true of coffee, it's true of pork bellies, true of orange juice, it's true of the labor market as well. So that's why we're seeing this slowdown in job gains. And I want to say again, we're not sailing off a cliff, it's not catastrophic, it's just a slower rate of growth than we have seen in the past. Something similar is happening in the housing market. Housing is, of course, a very regional market. So I'm showing you here, year over year, price gains in housing for a wide variety of major American cities. And you can see in red the average for the United States of America. Here too, nothing catastrophic. It's just that these gains have slowed down. Year over year, the average price of a house in the United States up 1.8%. That's lower than inflation by a little bit. So at the margin, and I'm going to use that phrase a lot, at the margin, housing is not quite the support for consumer spending and the wealth effect that it has been in the past. When you lay on top of that the psychology of spending, whether it's uncertainty about tariffs, uncertainty about taxes, uncertainty about a wide variety of things, it won't surprise you to see that consumer sentiment has taken a turn down. This is not official government data. This is a study done on a monthly basis by the University of Michigan, their economics department. And they've been doing it for decades. So it is a really, really rich set of information that we have access to. And in doing so, they don't really say, how are you feeling? It's not as simple as that. They ask a number, are you going to fix my, yeah. Is that better? Okay, should I start over now? Not that this is on the left side. Thank you very much. Shout out for the tech guys for correcting my user error. These are not measures of anything. These are simply index levels, and they're based on a whole variety of questions that lead up to the aggregate expectation of how are you feeling now, that's current conditions, and what are your expectations for the future, that's the red line, future expectations. What's remarkable to me is that these measures of consumer sentiment are at or even below where they were in March of 2020. That's extraordinary. In March, April, and May of 2020, as the pandemic was just taking root and everyone was working from remote places, if you were in an office or masking up or taking precautions, there was not a whole lot to be confident in, and yet somehow where we are now is right back where we were then. That has some pretty negative implications for consumer spending. This worries me because, again, the psychology is a really important driver of spending. Why is this the case? What are people anxious about? If you dive a little bit further into this data that the University of Michigan provides, you can begin to see where the real anxiety is. One of the questions that the survey asks is simply, do you think unemployment a year from now will be higher or lower? And in the last survey, 71% of the respondents said, I think unemployment will be higher. Now, that's not really a question about my own job. That's a question about the economic backdrop. But if you look at this graph, and this is a 45-year graph, that's about the highest on record. Phrased differently, the respondents to this survey, American consumers, are more pessimistic now about unemployment than they have been at any point in the past almost half century. Think about the psychology of that. Even if you are confident in your job, you're not worried about your job. That psychological backdrop is one in which you're a little less willing to take a trip or renovate the kitchen, buy a new car, make a major purchase. And again, the psychology of this is really important. Fortunately, inflation hasn't really responded to tariffs the way in which a lot of economists expected they would. The reason for that is that a lot of American companies have simply absorbed the cost of tariffs into their profit margins. In other words, they're not, at least yet, passing those costs through to their end consumers in the form of higher prices. I say yet because I wonder if that's not a dynamic that will unfold in 2026, where those companies that have pricing power choose to exercise it. Not quite there yet. This is not official government statistics. This is a different measure of inflation that looks at a wide variety, a much wider variety of inflationary points than the government statistics do. 2.5%, it's a little bit lower than the official government statistics. The difference that I've been able to pull out of this is that the housing market, or housing rent for the most part, is a much bigger part of the official Bureau of Labor Statistics data than it is in this data series. Here too, that University of Michigan sentiment survey is helpful because one of the questions asked in the survey is, what do you expect inflation will be a year from now? Now, the respondents in this survey are not economists. But that's the point. Again, it's all about the psychology and the expectations. The median response to that in the last data point in October was 4.6%. And again, inflation today in the States is somewhere around 2.5 or 3. So if you combine these things together, most Americans think that unemployment will be higher a year from now and that inflation will be higher a year from now. It doesn't mean those things are true. I'm not concerned at this point with whether or not they're true. What I'm concerned about is how does that affect consumer spending? And again, because that's 68% of the equation, it's really big. The answer so far is it hasn't affected consumer spending at all. This is miraculous to me. This is an absolute graph of consumer spending measured in nominal dollar terms. The last data point on that page is about $16.5 trillion. Phrase that differently. American consumers spend $16.5 trillion a year. And again, that's pretty much a straight line, with the exception of the pandemic for obvious reasons. If you really wanted to hone in, you might look at the last few months of consumer spending and say, there's a little bit of a fibrillation there. There may be a little bit of a slowdown beginning to take place. I'm not sure that's enough to hang my hat on yet. It turns out in the United States of America, when the going gets tough, unemployment is expected to rise, inflation is expected to rise, uncertainty on tariffs, et cetera, et cetera, et cetera. When the going gets tough, the tough actually do go shopping. And this is the evidence to prove that. If you peel back the layers of this, I often get asked the question, who's doing all that spending? Here's something that also concerns me a little bit. Half of that spending, so in other words, about $8 trillion of that spending is accounted for by the top decile of household incomes. So the wealthiest 10% of American households account for half of that spending. And I think what solves the conundrum, the reason why spending remains so robust despite these growing concerns about the labor market, about inflation, is that that top decile doesn't really count on a job for their wealth. And they don't really care that much about inflation because inflation, the price of eggs, the price of coffee, whatever it is, doesn't really affect their spending patterns. What does that top decile of income really care about? And the answer is the stock market. That's what the real source of wealth is for that top decile. And of course, the American stock market has continued to do very, very well this year with some volatility. So one of the things that I'm watching carefully as we head into 2026 is whether or not there's a tighter linkage between the stock market and the real economy than is usually the case. Phrased differently, if we get a stumble in the stock market, I wonder if that will translate into a downturn in spending simply because that will affect that very highest decile of consumer income. So I'm watching that as a dynamic pretty closely. The other dynamic that I watch closely, this is a very busy chart, is a measure of household finances. What you're looking at here is delinquencies, credit delinquencies. And what I'm measuring is the amount of outstanding consumer debt that's more than 90 days delinquent. I picked 90 days because that doesn't imply you missed a payment. It's 3 payments. So something's really going wrong. And the one line on this page that's the most concerning is credit cards. So 12.3% of outstanding credit card receivables in the United States are more than 90 days delinquent. The reason I focus on that is it tends to be a leading indicator. The good news is there is no sign of stress in the very important mortgage market. That's at the bottom. Mortgage delinquency is less than 1%. HELOCs are home equity lines of credit. So very, very similar to mortgages. No signs of stress. But that rise in credit card delinquencies, that rise in auto loan delinquencies, those tend to be the early indicators of stress elsewhere in the economy. So the two things I'm watching, a linkage between the stock market and spending at that highest level of household income, and also whether or not this growing financial stress at the household level begins to leak into other areas of the economy. That's not a forecast, but it's something that keeps me up every once in a while at night. One of the ways I measure that is with an economic index that I made up. I call it the misery index, focused on the fact that what really drives most households is, as I've already alluded to, unemployment and inflation. Some years ago, I thought to myself, well, why don't I just add those two things together? Unemployment plus inflation. Up is bad. That's higher unemployment, higher inflation. Down is good. That's lower unemployment and lower inflation. These are two data series, by the way, you should not add together. Nobody tell any of my college economics professors I've done this, because it's economic malpractice. But as an indication, as kind of a general indication of how people feel, I think this is probably a pretty good measure. And here the answer is it's kind of okay. That last data point in red, 7.2, again, that's not units of anything, is lower than it's been for most of the past, how long does that go back? 75 years. So yeah, unemployment may be a little higher, inflation may be a little bit higher, but relative to periods in the past in the American economy, it's not that bad. It's kind of a meh economic outlook. Same is true if we look very briefly at the manufacturing sector. And again, consumption is the most important part, but here's manufacturing. This is another sentiment index. And the way in which this index is calculated is that gray line at 50 is sort of a middle ground. So readings above that line indicate economic optimism. Readings below that line indicate economic pessimism at the manufacturing, at the industrial level. It's been pretty much below that line for a couple of years now, but not by a lot. So that's not that bad of a reading. It's sort of a middle-of-the-road type expectation for industry and manufacturing conditions. If you untangle it a little bit, it looks a little bit different if you look at trade. If you look at companies that are focused on the export sector or the import sector, those readings are a fair bit below 50. No credit for guessing why that's the case. The uncertainty around tariffs, on again, off again. We're going to get relief, Scott Bessent says, someday, but today is not that day. Hope springs eternal. All of that uncertainty weighs on business spending. We hear it from our clients at Brown Brothers Harriman. If I'm trying to make, as a business owner, a capital commitment to build a new factory, build a new plant, open a new market, hire new people, really hard to do that in a period of such policy uncertainty. And we can measure that as well. This is a great study that was done by a trio of economists at, can't remember where they are, Northeastern University, I think, who looked at and did a big sort of data and an AI analysis of the combination of analysis and research and press and reporting on combinations of words like policy, regulation, doubt, uncertainty, anxiety, and they turned it into an index. This is another graph that goes back 30 or 40 years, and you can see where we are now at 369, again, not units of anything, is pretty high. Once again, you see the pandemic in there, a whole lot of policy uncertainty around a truly unprecedented event. What is interesting to me is that the peak of the tariffs in April of this year was in, again, even more policy uncertainty than was the case during the pandemic. That kind of puts it into context. And although there's been a little bit of relief, where we are now is still more uncertainty about policy than has been the case for the majority of our working careers as I look across this room. So I don't envy the position that people in this room are in trying to make decisions that have some relationship to the American economy or tariffs or the prediction thereof. Some people last night at cocktail asked me what I think would happen with tariffs, and I said, not only do I not know what's going to happen with tariffs, I don't think the President of the United States knows what's going to happen with tariffs. Hence the uncertainty. It really depends almost on a day-to-day basis. This is an environment, given all of this uncertainty, given these sort of gathering storm clouds of economic data, that ought to lead the Federal Reserve to lower interest rates. And again, they have begun doing that. What you're looking at here is the Fed funds rate. That is not a market interest rate. It's the official rate set by the Federal Reserve, but of course it is an interest rate that affects the rate at which we borrow money and you borrow money and we invest money. To the left of that red line are historical changes, so the Fed has begun to gradually lower interest rates. To the right of that line is future expectations, and not my own expectations, but the expectations of the futures market, so the aggregate expectation of all participants in the market. And if you look over the next year, each of those bars represents a Fed scheduled meeting date, the next of which is December 10th. The expectation is that the Fed will continue to gradually lower interest rates about 4 times for the next year. So a full 100 basis points, that would bring the Fed funds rate, short-term rates, down to about 3%. There are no guarantees in this. Again, this is a futures market expectation, but given this balance between economic activity and inflation, I think that's probably pretty accurate. That says to me borrowing costs are likely to come down over the next year in dollars, maybe not by a full 100 basis points, because of course market rates and Fed funds rate are different things. But something in that neighborhood is likely that I would expect. And of course, between now and the end of this graph, there will be a new chairman of the Federal Reserve. Jay Powell, who's the current chairman, his term expires early next year. The president has yet to announce who his appointee will be, but the names that are widely talked about are all names of people who are serious economists and serious central bankers. So I expect this kind of approach to easing monetary policy will remain intact regardless of who the next chairman of the Federal Reserve is. And we ought to learn that in the next month or two, I would anticipate. So I'm rounding towards home. A couple of things that I'm watching carefully. I will put my contact information back up at the end. Feel free to reach out to me, any of my colleagues at Brown Brothers Harriman. And I think this presentation will be on the Center Cafe website as well. So if questions arise after we part company, again, don't hesitate to reach out. I think what we're looking at is a slowdown in economic activity more so than a recession. Having said that, the fourth quarter, this current quarter GDP mark in the United States, is almost certain to be negative because of the government shutdown. That's kind of artificial, and as an economist, it's very frustrating to have to look through that disruption, because what will happen in the first quarter of next year is you'll see a rebound. So that, by the way, will give politicians the ability to say, well, the whole fourth quarter slowdown was really the shutdown in the government, but the first quarter rebound is because of my brilliant policies. I could write those headlines already. You'll kind of have to average those 2 quarters together to get an idea of what's really going on. What I'm watching closely is this second point here that I've alluded to a few times is consumer sentiment. If I'm wrong, if this actually is a steeper downturn, it will be because of this psychological break on consumer spending, growing anxiety, growing concern. That is not my expectation at present, but that would be the translation mechanism into a real economic slowdown. Again, not an expectation, but certainly something that I'm watching carefully. Even if the tariff uncertainty eases, so as you all know, the Supreme Court has heard arguments about the constitutionality, the legality of the way in which the White House imposed the tariffs that are currently in place. It will not surprise me, I'm going to make a forecast now, it will not surprise me if the Supreme Court rules that the use of the International Economic Emergency Policy Act was unconstitutional. It will not surprise me if the Supreme Court, in other words, strikes down the vast majority of the tariffs that have been put in place. But recognizing how disruptive that is, it would also not surprise me if the Supreme Court said, having made that ruling, we are going to postpone that ruling for a period of time, 90 days, to give the White House the opportunity to go back and find a different, more constitutional way to impose those tariffs. The most constitutional of which would be to go to Congress and have Congress pass a law, because that is very, very clearly Article 1, Section 8 of the Constitution, Congress's responsibility. So even if the Supreme Court rules, almost no matter which way the Supreme Court rules, the tariff uncertainty is likely to linger because the White House views tariffs, I don't need to tell you this, as the solution for a wide variety of problems. In very much the same way that a man who has a hammer sees every problem as a nail, the U.S. White House sees every problem as something that tariffs can be used to solve. Household finances, again, is something I'm watching. We've talked about that as well. For markets, I think the Federal Reserve is likely to continue lowering interest rates because of all these economic concerns, considering that tariffs ultimately are not inflationary. That sounds a little bit counterintuitive, but economists, central bankers, would define inflation as a sustained rise in prices. And of course, tariffs in and of themselves are not a sustained rise in prices. If a tariff of, let's say, 20% is imposed on an economy, that looks more like a step function, a one-off, a price shock, than it does a continual rise. And so I believe the Fed will conclude that interest rates really don't have an impact on tariffs. If the Fed didn't like tariffs and decided to raise interest rates, that doesn't mean the White House changes its mind, or vice versa. So I think the Fed will continue to err on the side of economic challenges and continue to gradually lower interest rates while clearly keeping an eye on the potential inflationary impact from tariffs. Markets expected a 25 basis point rate cut at the October 29th meeting. They got it. The Fed next meets again on December 10th. I think by then we will have backfilled enough economic data, and there's enough private economic data the Fed has access to warrant yet another rate cut. Equity markets are on a tear, and I often get asked the question from clients with all of these growing concerns, how is it that U.S. stock markets, the S&P, NASDAQ, are doing so well? There's a disconnect there, but the disconnect is really resolved by a couple of things, one of which is corporate profits are very healthy. Corporate profit growth of public U.S. companies this year is likely to be up 11%. The expectation for next year, which is way too early, is for profits to rise 17%. That's really healthy corporate profits growth. When you lay on top of that the prospect of continually lower interest rates, that's a really good backdrop for equities. A lot of this, of course, driven by a spending boom in AI and technology that reminds me a little bit of the late 1990s. Dating myself and drawing that analogy, but in the late 1990s, I was managing public equity portfolios for Brown Brothers Harriman, and a lot of what's going on today feels very similar to that dot-com boom. If there's a difference this time, the difference is that those big leading companies like NVIDIA are real, live, honest-to-God companies with profitability, with revenues, with products. In the late 1990s, those of you who remember, a lot of what was really driving that dot-com boom and then bust were companies that didn't have any profits. In some cases, they didn't even have any revenues even. Such was the bubble, such was that. I don't think we're going through that again, but it's something that bears watching. With that, I will bring my comments to the end, and thank you again for inviting me to join you. My contact information, I think on the app, you can reach out and ask questions as well, but I will be lingering for the rest of the day. Look forward to talking with some of you then. So again, thank you for having me join you today.